viewers. Today we're going to be talking about a company which has recently been the talk of the town in the trading community called Suumaya Industries. When we heard the news about the company's marvelous top line as well as bottom line performance, we became curious. A quick Google search opened our eyes to a multi-bagger. Suumaya is up 180.9% in the last 6 months, 848% in the past 1 year, and since the last 5 years has earned a whopping 2,690% returns for its investors. Now that absolutely piqued our interest. We immediately turned to Screener for a quick glance and realized that Suumaya's mind-boggling reported numbers really could stupefy not just us, but each and every investor out there. In the latest year, ended March 2021, the company reported a stupendous 1,062% YOY increase in sales, suggesting revenues were up 11 times. Profits exploded even more, almost 45 times, an increase from rupees 8 crores in March 2020 to 358 crores in March 21, just within a year. All thanks to Suumaya's operating leverage. As analysts, no one more than us would truly appreciate the beauty of the ROCE's deep J curve. It started from 1% in 2015 and kept moving up in the following years to 2%, 3%, 9%, 15, 22, and finally in the financial year 2021, ROCE stood at an exceptional level of 151%. What's all the more fascinating was how close the ROCE and ROE numbers were. 151% ROCE and 150% ROE. Now that implies that there was barely any debt. Some more brownie points for the company, right? Then we came to the cash conversion cycle. It's as short as 5.4 days, suggesting money invested in the business today can be converted into cash within 6 days. Just wow. But the cherry on the cake, in the eyes of the retail investor of course, was that at the current price, the shares of Suumaya trades at only 2.9 times its earnings, much lower than the industry PE of 45.5 times. Now bear in mind that the stock price, just like the stock price, PE may too change every day. But the difference between the two may most certainly not vanish overnight at least. Now, undoubtedly, prima facie, Suumaya looks like an excellent company running an exceptional business. But we decided to take the company's financial analysis just a notch higher by turning to the cash flow statement, which is the biggest clue provider as to how a company is balancing its receivables, payables, how is it paying for its growth, and overall how is it managing its flow of funds. However, to our disappointment, the cash flow from operating activities or CFO was negative 10 crores, indicating that when compared to the operating profit or EBITDA as we call it, the company certainly isn't converting its reported profits into any cash at all. This undesirable negative cash from operations made us question even the earlier visited cash conversion cycle. The short cash conversion cycle implied that it would only take 5.4 days, right, to convert its investments in inventory and other resources into cash flows. Then how was it even possible for the company to be unable to convert any sales into cash? That's a question we all had in mind, right? Now the answer is pretty simple. It's credit. Going back and forth, we noticed that Suumaya did manage to keep its cash conversion cycle low, but at the cost of humongous trade receivables and payables. Both the days payables as well as receivables stood in the range of 300 to 315. Now this is what shortened the cash conversion cycle. Simply put, a business has to manage credit from both the supplier and the distributor side. The ability to buy something now and pay for it later. Sales to distributors or even direct customers could be essentially put on their bill rather than collecting cash. This put on the bill amount is essentially termed as trade receivables, which also works on the supplier side. trade payables or money to be paid or held back from the business's suppliers, vendors, etc. And days payables or receivables is simply the number of days the company takes to make or receive this payment, this on the bill payment in cash. Now in Suumaya's case, looking at the bigger picture while analyzing cash conversion cycle, days payables and receivables, when we put all of this together, there seems to be a lot of money stuck with receivables, which may exactly be the reason why the company isn't able to actually pay up to its suppliers as well. In fact, when we scratched the surface just a little, we spotted the trade receivables number to be almost half the company's reported total revenues, hinting at major credit sales. Now, we aren't saying that Suumaya is a bad stock or bad investment in any case. But what baffles us are the numbers, as we don't seem to make perfect sense out of them. What we came across are barely just red flags. Red flags for us at least. Unlike popular opinion, red flags necessarily do not mean that there's any scams or fraudulent activity with the company. Red flags just make us more cautious, and all we try to do with every stock is play the devil's advocate. And agreed, we haven't yet read even a single page of the company's annual report, neither have we dug deeper into its future growth prospects. But for us, with these numbers, the story ends here. To know more about us and how we analyze stocks, what's our investment philosophy like, you can always visit our website www.moreindia.com. Thank you.